want to finish up the demo problem that we started today in class. I actually have the full solution already completed here, so I'm just going to quickly talk through the answer, and you can walk along with me, and I'll just explain the numbers for you, okay? So we had gone through September 4. On September 10, the company received a bill from the Daily News for advertising the opening of the cleaning service. So if we look at what did it receive and what did it give up, I didn't have space here to write it out, so I put it up here. So the company received advertisement. What did they give up? Well, they haven't paid for it yet, so they did not give up cash. They owe money for it. So that creates an account payable with the newspaper. So the company received advertising in exchange for owing money in the account payable. Then, second step, move over to your accounting equation and assign elements. Advertising is a cost that's been used, so that's an expense. So expenses cause retained earnings to go down, so we will decrease retained earnings for advertising expense, and I abbreviated advertising. And then the account payable is growing. Account payable is a liability. It's going up. So we have a decrease and an increase on this side. Nothing happens to assets then. Then we assign our debit credit rules. Liabilities go up. If a liability goes up, that is a credit. And if retained earnings goes down, that is a debit. So we're going to debit advertising expense, credit accounts payable. So we go to our journal. We can see that's what I have listed out here. Here's our debit. Here's our credit, $200. We go and see the posting. Here's the posting of $200 to advertising expense. In your account, you won't have this line yet and the balance yet. You'll only be putting the $200 debit. Likewise, in accounts payable, here's our credit on September 10, and you will not have filled out the balance yet. You'll just have a $200 credit. So there's our debit and our credit. Next transaction, on the 15th, perform services on account for $6,200. So we provide services to our customers. What did the customers give us? Well, you would like to think cash, but they haven't given us cash yet. So we have what we received is an account receivable from that customer. What did we provide? We provided services. Well, what is that? That's service revenue. If I provide services or goods, that's how I earn my revenue. So the company received an account receivable and provided services, so they earned service revenue. That's what we received. Here's what we gave up. We'll take this over to our accounting equation. Accounts receivable is an asset. It's growing, so we have an increase to accounts receivable. I abbreviated that. Service revenue is a component of retained earnings. Revenue causes retained earnings to go up, so we've got an increase in retained earnings for service revenue. So accounts receivable will go up on the asset side, service revenue will increase on the retained earnings side. Third step, assign your debit and credit. Assets go up with debits, so I'm going to assign it a debit. Over here, stockholders' equity goes up with credits, so I'm going to assign service revenue a credit. I'm not making the entry to retained earnings. I'm going to make the entry to service revenue. So let's go to our journal. And here on September 15, we have a debit to accounts receivable. You can see I just abbreviated receivable, causing assets to go up. We have a credit to service revenue, causing retained earnings to go up. And I see I forgot to put the other side of the bracket there. Debit, credit, $6,200. Let's go post it. Under accounts receivable, on the 15th, we debit accounts receivable $6,200. Right now, that's all you would have in your account. And then we go over to service revenue, and we have this credit of $6,200. That's all you would have in your account at that time. We've already done the dividends on the 20th. Cash went out for the dividend. We've made that journal entry. And now on the 30th, received $5,000 from a customer billed on September 15th. So this customer billed on September 15th, remember that went into accounts receivable. So what are we receiving here on the 30th? We are collecting cash. What are we giving up? We're not giving up services on the 30th. We already provided services on the 15th. On the 30th, we collect cash, and the customer's accounts receivable is what we give up, or at least part of it. So cash comes in, we give up part of their accounts receivable. So cash is an asset, it's going up. Accounts receivable, ACCT is my abbreviation for accounts receivable, it's going down. So so nothing happens on the other side of the equation. Nothing happens to liabilities and stockholders' equity. Cash is going up, that's an asset, assign a debit. Accounts receivable goes down, that's an asset going down, assign a credit. So I debit cash, credit accounts receivable. So on the 30th, we debit cash, causing assets to go up. We credit accounts receivable, causing assets to go down, $5,000. Let's go post that. So we can see on September 30th, we have a $5,000 debit. And then also, we post our $5,000 credit on September 30th to accounts receivable. Now, notice after all of that, I will draw a line in each of the accounts. For assets, anything on the debit side is a positive. Anything over here on the credit side is a negative. So I take $20,000 plus $500 and I subtract all of these credits, and I will get a debit balance, a positive balance, $12,100. And I just put BAL for balance. Accounts receivable, I take my $6,200 debit, subtract the $5,000 credit because it's a negative amount, and I have a positive balance of $1,200 on the debit side. And I just do that for each account. I draw a line, arrive at its balance. Over here, under liabilities, I would have drawn my line. I have a $200 credit. There were no debits, so the ending balance is a $200 credit balance. Likewise for payables, $15,000. Nothing happened on the debit side, so that is its balance. Same thing with common stock, revenue, and all of these expenses. I just draw my line, I draw my line. There was only one transaction, so that is its balance. Now, I want to make sure that in all of these accounts, debits equal credits. So I'm going to take these debit balances and put those in over here on my trial balance. So I take my ending balances, $12,100, $1,200, $1,200, and $25,000. I enter those as debit amounts on the trial balance. Likewise, I'm going to do the same thing for my credits. So I take these credit amounts, I take these credit balances, $200, $15,000, $20,000, and $6,200, and I will enter those in. Lastly, I have expenses that I haven't put the balances in, so I take those balances and I enter those in on my debit side. Then I add up all the debits, I add up all the credits, and those each total $41,400. Now, in the final step, let's look at how we take these numbers from the trial balance. Right here's our assets, liabilities, stockholders' equity, revenue, and expenses, and we write out our financial statements. So, we're just going to take this service revenue, report it there, take these two expenses, report them there, arrive at our net income. Remember, this was the first year and month of business, so there wasn't any beginning retained earnings. Net income flows into retained earnings. We get our subtotal of $5,000. We have a dividend here from the trial balance of $700, and we end up with $4,300 of ending retained earnings. That will go forward to the balance sheet. So we see retained earnings, we bring that $4,300 forward. Then the rest of this are numbers pulled from the trial balance. So here are our assets, and we take those numbers and put them over here. We have our 3 current assets, we subtotal that, we have equipment, and then we add up our assets. Accounts payable, we have 2 accounts and notes payable. We list those out. Total current liabilities, $15,200. And then the common stock, $20,000. Bring that over. We already had the $4,300, and our assets equals our liabilities and stockholders' equity. So that's the complete accounting cycle.